everybody. This is John Llodra from New Harbor Financial Group for our weekly client and friends update. Very happy to be with you today. It's a little later in the week than we typically issue these videos. It's actually Friday, the 17th of November. But very happy to be with you and hope this video is timely and helpful for you. Just by way of introduction, we're getting a lot of unexpected new viewers. Folks have found us, and to be clear, we're not doing this to become celebrities, but more to just share our insights and activities with our clients to keep them as informed as we possibly can as to what we're seeing and what we're doing. But for those folks who aren't familiar with me and our firm, my name is John Llodra. I'm one of the founding partners of the firm, and we've got a great team. We've got a team of 7 people, and we manage just under $500 million of household assets for really people across the country, everyday people from a wide range of wealth and income levels. And we're very fortunate to have the great clients that we do. And it really makes our jobs, which can be difficult, special, because it's all about the people. And I guess I'd like to just kind of pull a couple taglines from our website just to kind of emphasize why we're here. If you go to our website, there's a little tagline, simply data, insight, and purpose. And I think that really, we spend a lot of time kind of coming up with some simple words to describe why we're here. First of all, the data part, we want to make sure that we rigorously look at data, both short and long-term market and economic data, to inform our decision-making and our guidance to our clients. But of course, data by itself is just data. It's just a bunch of numbers. It's really the insight part where we try to, with discipline, extract both from our own analysis, but we work very hard to take in the perspectives of a wide range of other folks, other strategists, other third parties, so that we are always challenging ourselves. And that's where we hopefully come to some insights as to what this data is telling us, and most importantly, what it means for how we should be guiding our clients. And it's never black and white. I oftentimes like to use the imagery of a jigsaw puzzle. As you start to build a jigsaw puzzle, a picture starts to emerge. Could be a favorable picture or a less than favorable picture. Even if all the pieces aren't quite in place, you can start to see an image, and with some judgment and some insight, you can kind of hopefully complete that picture without having the full realm of information. And then on purpose, really why are we here? It's about you, our clients. We're not here to play games in markets or flash up the most interesting data stats that you might see on things like CNBC. It's really about bringing it home to what's important to our clients. And really, in that regard, quite simply, we hope to empower our clients to live comfortable, carefree, worry-free lives as relates to how their financial assets fit into their picture. Now, that's a very tall task. It's impossible for we humans to completely shed the stresses of how money fits into our lives. But that's our mission, and I hope to use today's video a little bit differently. Recent videos we typically oftentimes will get into data and charts and things like that about the markets. I'm going to do things a little differently here today. I'll give a quick comment about the markets. In fact, we did a live Q&A with our clients, those that registered anyways, earlier this week, where we got into some of that. And anybody that wasn't available to participate in that, please reach out to us. We're happy to send you a link to that video recording. But just touching quickly on the markets, and then I want to take a big picture back to the purpose and what it means for our clients. Last couple weekly videos, 2 weeks ago, I did a video that pointed out that the stock market had reached a technical correction, and that's simply when a stock index drops 10% or more from its recent high. Okay, so technically, the stocks from their July 31st of 23 high had pulled back more than 10%. So we were in a technical correction. But I pointed out that some of our technical indicators were suggesting a little bit of an exhaustion and oversold nature of the market, and that we were watching and be preparing for a likely bounce higher. And then last week, Mike Preston, my partner, another founding partner of this firm, further elaborated on those technical indicators and how many of them are pointing to at least short-term likelihood of further advance higher in the market. And in fact, that's what we've seen over the last few weeks. We've seen actually quite a dramatic bounce, one of the sharpest rallies in recent memory, anyways. And we saw things like the so-called Zweig thrust, which is basically just rarely happens. And I don't want to get into the details. All to say, it was a very, very sharp rally, and thankfully, our clients' accounts benefited from this, both across some of the equity exposure we have, some of the commodity and precious metals exposure we have, and as well as some of the longer-term bond exposure we have. We still remain very heavily weighted towards very safe, secure, liquid, short-term treasury bills. But some of those things that benefit certainly have helped our clients in recent weeks. And we did actually tactically get somewhat more invested in the stock market, both through adding some stock exposure, but also in booking profits on some hedges we had on the stock market, and in effect expanding our stock market exposure. So I want to just point that out, but I'd like to take a step back, again, back to the purpose, really how this all factors into our clients. And I think if I could distill what I think most of our clients' real worries are, it's not about, although they may feel the fear of missing out on short-term bounces in the market and this and that. I think their real fears are the possibility of running out of money during their lifetimes. Quite simply, we think the overall objective should be to, with the greatest degree possible, increase the likelihood that our clients will have what they need financially when they need it. Pretty simple, right? It's obviously very complex when you factor in the machinations of the markets and the understandable psychology of fear and concern and stress that this all can bring people. So our mission, hopefully, is to make that a bit, achieve that goal, help our clients achieve that goal, but also provide the perspective, insight, and might I even say counseling to put at bay some of the demons that we as humans want are destined to be stressed out by. So in that regard, I wanted to kind of talk a little bit about this idea that you have to be in the market at all times. In fact, our industry, the financial industry, does a great job at basically saying, hey, don't even think about anything other than fully investing your funds for the long term. Keep it passively invested. Close your eyes. Don't worry about drawbacks in the market. Yeah, they'll happen, but they always bounce back. And just basically put your head in the sand. When we look at data and draw insights from that, we think there's a better way. And I'm going to try to illuminate some of the data and insights that informs our philosophy in that regard. So the common, kind of cliche in the financial industry is it's time in the market, not timing the market. And I get it. If you just simply hold passively over the last 100 years, you have a $1 turned into a gazillion dollars, and you could have bought a country, right? But it's quite a bit more texture than that. So what I'd like to show you is some stats here of actual market daily moves and kind of the consequences of missing out on some of those days. In other words, to make the point that you don't have to worry about the very, very short term as much as you think. So let me share my screen here, and we'll kind of dive through some of that. Okay, so this first chart just shows the since 1950 through yesterday, actually, the 20 worst and best days. I have a little bit of a label error here that I'll fix in a next iteration. But these are the 20 worst and best single day moves in the S&P 500 since 1950. So you can see the biggest all-time drop was on Black Monday, October 19th of 1987. Single day drop was 20.5%. Huge drop, huge drop. And then the single largest move was 11.6%, and that was during the financial crisis great financial crisis. That was in October of 2008. So you can see it's pretty much speaks for itself here. One thing I want to tease out, and the next chart will actually show this graphically, is you notice some of the best days are lumped right in close proximity to some of the worst days. So for example, the worst day, October 19th, 1987. One of the very best days was just a couple days away from that, October 21st, 1987. You'll also see a bunch of really bad days in 2008, especially October 2008 timeframe and the summer of 2008, right alongside, not too far from some of the very best days, these top 2 best days, for example, in 2008. This next chart will show pictorially. This shows those things on a long timeline. So you can see a whole bunch of blue lines that shoot above here are the positive days. The ones that shoot below are the negative days. And you can see there's quite a clustering of the best and worst days right around each other. And that just tends to happen in very volatile, challenging periods that I'm not going to kind of pull in all the data today, but a lot of these periods coincide with periods of very high, extreme overvaluations in the stock market, deteriorating credit situations, recessionary indicators starting to come into view. I would dare say a lot of those things are present today. So we very much think we're in one of those times where we're likely to see big volatility up and down. So the question is, what does that all mean in terms of your investment results? This next chart shows basically, the Wall Street, the financial industry mantra would say, basically just stay fully invested. If you stayed fully invested over that period from beginning of 1950 through yesterday, you'd have a cumulative return of just under 27,000%. That sounds awesome. And of course it is. And of course, if you miss the 10 best days, well, geez, that return would get cut dramatically to less than 12,000%. Still a pretty good return, but vastly inferior to if you had just set it and forget it. But let's look at this. What if you just simply missed the 10 worst days? Well, suddenly your return would go from not quite 27,000% to over 77,000%. Now, let me be very clear. It's impossible with foresight to pick precisely missing those worst days. Okay, so this is not a suggestion that you can do this with precision, but you can kind of, we think, use data and historical patterns and periods to kind of greatly increase the chances of being able to miss those big periods that are demonstrably, kind of problematic for returns. So, for example, if we look at a period where you miss both the 10 best and the worst days, it's not quite as good as missing just the worst days, but at 34,500%, it's better than if you had just been passively invested. And the same goes if you look at widening it out to the 20 best worst days. Again, if you just miss the best days, your return suffers dramatically. It goes from almost 27,000% to not even 7,000%. But if you miss both the best and worst, 39,000%. I'm going to pause just for a second. Again, this is just in hopes of reoriented the focus here. We as investment managers certainly are watching the day to day, and we're going to use our data to, even in periods that are overvalued and not conducive to long-term durable returns, we're going to take very risk-measured approaches to hopefully help clients benefit from some of these shorter-term moves that technically aren't supposed to happen, the positive moves. So that's why, for example, I mentioned we added some equity exposure in recent weeks on expectation that we'd see a short-term bounce here anyways, and that bounce may further follow through into the end of the year. It wouldn't be at all surprising to see that, even despite the nasty fundamental backdrop. But we didn't do it with 100% of clients' portfolio. Right now, we're approximately about 25%, give or take, in equity exposure, if you factor out, kind of our hedges and things like that. And we still have a large position of client assets in, very safe treasury bills that are yielding at this time over 5% yield to maturity. So I want to be very clear about that. Now, one of the reasons the math I just showed you about missing the best and worst days is so profound is because of the economics of loss. Our mission, we think, is first and foremost to be risk managers, to help you gain by first not losing big. It's impossible for us or any manager to completely insulate a client's accounts from any downside. I can guarantee you there will be periods of downside. There'll be years or months where we'll lose money. I can guarantee you that. But we've tried very hard through our tools and our insights to limit the degrees of those declines and the volatility of those declines. So let me just show you another chart to kind of emphasize why we think that's so important. So here is quite simply a picture showing the economics of loss. What we see here is if you suffer a loss of a certain magnitude, it shows what the subsequent positive gain you would need to break even. So you lose 1%, great. You need roughly about 1% to get back to even. Same at 5%. If you lose 10%, well, you need a slightly bit more now to get back to even. And this is very simple. Take $100, you lose 10%, you're left with $90. You need 11% return on that $90 to get back to 100. Now you can see this is nonlinear. As you start to get deeper losses, the amount you need to dig back out is increasingly larger. So for example, if you lose 50%, that $100 becomes $50. Well, you need to double your money from 50 back to 100. So in other words, 100% return to get back to even. This is why so much of our approach is meant about being patient and mitigating the likelihood of downside returns. I'm going to go to another topic here. Well, it's actually the same topic, but one of the big risks in that big purpose of looking out over your retirement period, which could be 20, 30, 40 years or more for most people, and really making the objective of not chasing the maximum return in any given day or week or year, but in increasing the likelihood that you'll have sufficient funds for as long as you may live. One of the key risks in that pursuit is what I would like to call sequence of returns risk. And I'm going to pull in a couple of charts here that are going to be just snippets of a white paper, a special report, if you will, that we're going to put together on the 4 or 5 key risks to retirement, long-term retirement income security. That'll be coming in the coming weeks, or not too far off in the future as a quote-unquote special report, and we'll make sure we get that out. But I want to share a couple pictures, illustrations to give a preview of that. All right, so this basically shows a hypothetical scenario, and this is not too far off from something that might be very similar to a real life scenario. So let's say we have a client with a starting nest egg of $1 million, and let's say, and what I show here is the impact of how the sequence of returns can be so dramatically impactful, even if the effective average return is equivalent. So what I've done here is I've pulled in actual annual returns from the period of 1973 to 1997. That's a 25-year period. And I picked that not just randomly, but because, actually the 70s we think kind of maybe are a good analog for the period we're in, where we had inflationary issues, maybe stagflationary issues. We've got deficit issues, a whole bunch of similarities. Not saying it's perfect analog. You can see the 70s had two years of big losses, 73, 74, followed by, ultimately some very strong gains in the late 80s and into the 90s. This is approaching the very top of the tech bubble peak in the late 90s, in 2000. So what I show here is a hypothetical scenario, and this is very simple. We have more sophisticated software to model a client's individual situation, and we invite clients to engage us on this as relates to their own situation. But this shows a scenario where, starting with $1 million, a client would like to take $50,000, in other words, 5% of their portfolio, and increase that as a paycheck, if you will, to themselves, and increase that each year by 2.5% for inflation. So that's what this looks like. 50,000 becomes 51 and change in year 2, and by year 25, it's closer to 90,000 if you factor in inflation. And then what this shows is a starting value of $1 million, but if you suffer a big loss here in the front end, it becomes 17% loss, becomes 826,000. You subtract off the 50,000 you want to spend, you end with this value. Then that next value, that ending value, becomes starting value for the next year, and in this case, it would have suffered a nearly 30% loss. So on the left side here, it's a picture looking at the actual pattern of returns from 1973 to 1997. And what you see here in this scenario is not only does the portfolio value precipitously decline, but it actually runs out of money in 1994. So basically 21 years in to this 25-year horizon, you run out of money. in this scenario. And perhaps even, concerning before that is folks would be probably very stressed out seeing their $1 million down at 300,000 in the middle of their plan, basically. Now, the right side of this basically takes the same pattern of returns, but just reverses them. So the 31% in year 25 becomes the 31% in year one. The negative 17%, 0.4% loss in year one becomes a loss in year 25. Simply reversing the pattern of returns, you can see the simple average return is identical for these two scenarios. But look at the ending value. We have not only you're not running out of money, but a very steady growth. And this is what I would call the cost of bad timing or sequence of returns. It's basically this value less this value. You can see dramatically different scenario there. And all well and good, but what I would like to impart is these kinds of negative return scenarios don't just happen randomly. They happen from periods of very high overvaluation, very whistling past the graveyard kind of episodes in markets. And I would say that we're in one of those right now. And I would put a pretty high possibility of this kind of scenario more so than this kind of scenario in terms of the pattern of returns. I'm going to share one more chart here, just showing what happens to volatility. Going back to the earlier data, showing the best and worst days and how some of the biggest up days are clustered right around some of the biggest down days. Well, that speaks to very volatile periods. And this is a simple example of showing, I'll cut to the chase. We can show through simulation and other tools, this is a very simple model, but we have, again, more sophisticated tools. When it comes to funding a retirement paycheck to yourself over a long period of time, sometimes it's better to actually have lower returns but lower volatility than higher returns with higher volatility. And that's exactly what this chart is. This table is meant to. It's very hypothetical, of course. This is no way a suggestion how things will play out, because I've just modeled on and off years of big up versus big down. On the left side, 30% up, followed by 17.5% down. And on the right side, a more modest 15% up, followed by a much more modest, not even quite 5% down. You can see the average return on this more volatile scenario is 7.2%. On this less volatile scenario is only 5.5%. But you can see, if you compare the ending values on this side versus this, and I've highlighted in red, basically any years where the ending value is less under this scenario versus this one. So you can see, certainly as you get later on into the plan, you're ending up with less money, less nest egg remaining, even though the average annual return is higher here. It's just simply the impacts of volatility can be dramatic in terms of impairing your ability. And that gets back to the whole economics of loss chart I shared earlier, which shows how much you need to kind of have a miraculous recovery to get back from a deeper loss. So I hope you all have found these charts helpful. Again, this is just a simple way of trying to demonstrate how we can take data and draw some insights that really can inform not just the day-to-day, but most importantly, how we think clients should be positioning to achieve the real goal. And that's having the money you want when you need it. Not just today, not just tomorrow, but over your lifetime. We know for virtually every one of our clients, the monies they entrust to us, they don't get a do-over on. These are monies that more often than not represent lots of years of hard work, sacrifice, sometimes an inheritance that brings with it its own kind of requirement to be good stewards of. But make no mistake about it, we are here. We want to help you. We're open to conversations like this that can relate to your personal situation. But it's not an easy endeavor that we and you together are trying to achieve, but it's a critically important one. And we feel privileged that we have the opportunity to work with so many great clients on this journey. Well, with that, I would like to wrap it up and just say thank you for watching. We're a week away or so from Thanksgiving. I'll wish a happy Thanksgiving to everybody. If you miss us next week, I think Mike will probably be doing a video next week. But thanks again for watching and listening, and please reach out. We're here for you. Have a great day. Thank you.